go live. It says go live. Now what I do, because
Yeah.
it's going to become a ritual for me, but it's also because I don't believe technology. I feel like this is a matrix type of thing and anything could happen. So now what I do is I go to my Twitter feed. I see us. I see us.
All right, we're live.
We are live. This is so exciting for me. So now I go back to you because I can't see you. That's it. We are live. We did it. Such a pleasure to see you, man. And we're going to be joined within seconds by a lot of people. And when we're joined by them, that's when I'll know that that we are here. So I see that we are here. I truly do exist, and so do you. So what a pleasure to see everybody. And now people are joining. So thank you so much, Personas, for being here. And Party Through It USA, thank you again. And Lunatic Farmer, thank you so much. And this is going to be really exciting, right, Ian?
Yep.
It is. It is. I've been looking forward to this. I've been meaning to have another breakfast or lunch or dinner with you. Do you know for about 3 years? Did you know that?
No, I did not know that.
I've got you on my to-do list back from 2015. I guess we had breakfast
You're
around.
better at this than I am. You track people over time. That's a really good skill.
I'm meticulous. I'm meticulous in everything. I keep notes of everything. I keep a daily log on everything. And you're going to be included in this daily log. And you haunt me because I still have you in my old daily log, and I still see it periodically. So I want to thank everybody for joining us and allowing us onto their feed. This is very exciting for me. And thank you. And I hope we're good guests on everybody's feed. Ian, would you be kind enough to introduce yourself?
Sure, Adam. So you asked me to do a 5-minute intro, which is pretty long. I'm going to start in the beginning. I'm from Ohio originally, which you'll probably pick up from hearing the Midwest twang in my voice. Born and raised, lived there for 18 years, went to college on the East Coast at MIT, came out of MIT and went right into venture capital. And it was kind of an interesting story. When I was in college, I did a little bit of work around energy pricing as an intern. So I happened to know a lot of insider knowledge about how energy prices are calculated. And I was able to get a job at DLJ as a summer intern. And when I showed up, I was hired by the energy group. And when I showed up, they put me in the tech group because they were competing against Frank Quattrone at the time. And they wanted more MIT people. So I became a tech banker very briefly, and then was able to get into venture full-time after college. Was 3 years at a firm called Boston Millennia, where I did a mix of stuff. They had primarily two businesses, a tech business that was focused on optical switches and semiconductors and hard science in the Boston corridor. And then they had a healthcare practice that was doing genetics and drug development. So I did that, then went to business school at Columbia. I went to Columbia because I wanted to start a company. And at the time I had this idea to do an encryption business called Strong Data and take the CVV2 code on credit cards and turn that into two-factor authentication like RSA was doing, if you remember those clunky tokens that people used to carry around. So I built a prototype and I filed some patents, and I raised money from business plan competitions. And when I was graduating, I got this 100K prize from Columbia to go start my business. And they introduced me to an illustrious alumni named Alan Patrikoff. And Alan at the time was probably 71. And he had built this firm called Apex, which I was somewhat familiar with, but not really. Apex at the time was a mega buyout firm. I was in early stage venture before. And Alan had retired from Apex. He was in his 70s already. So he basically retired at age 65 and then worked in US foreign aid to Africa. So I sat down with him and I said, I need $4 million for Strong Data, my company. And by the end of that conversation, he had convinced me to join him to launch a new venture fund called Greycroft and put Strong Data on ice. There's a whole story about what happened to the Strong Data stuff too, if we have time later. So we started Greycroft together, and my partner Dana, who's the third co-founder, she was living in Los Angeles at the time and working together. And ultimately, what happened when I joined Alan, he had 30 million raised, and Alan's fundraising journey was sending faxes to his friends with a memo and a cover sheet saying, "I'm raising a new fund. Here's a fill in the blank. Just let me know how much you're interested in, and I'll follow up with docs." And through a fax machine, he raised 30 million in about 3 weeks back in '06. And I joined him because he had enough capital to pay my salary and for his 2 admin. And then by the end of the summer, we tapped out at 75.
Wow.
And so all again via fax machine and emails. And then Dana came on board full time, and she stayed in Los Angeles. So we ended up being bi-coastal from day one. So fast forward, the Greycroft journey alone is like a 3-hour conversation, but we've gone from 75 million under management. We were 75 for the first 4.5 years. It wasn't until 2010 that we raised the first institutional fund. But from 2010 to the present, we're now at 2.2 billion.
Oh my gosh, that's awesome.
Yeah, it's been a big rise and a lot of work. And from a business perspective, there's now two business units, way we refer to it inside of Greycroft. We have our early stage venture business, which is on fund number 6. And that fund we closed it in August, maybe this year, which is 315. And then we've got our growth business, which is on fund 3. And the most recent growth fund we closed in March, and that was 375. So, and each of those businesses is staffed with full teams. So it's like it's a real company, Greycroft. We're about 50 people.
I remember you guys when you guys weren't 50 people, right? I remember you guys.
We were 3 people, probably.
I remember Dana. I remember you. I remember Bo Peabody. Remember that?
There you go.
And I remember when you guys did Huffington Post, because I knew the co-founder. I forget who it was, but
from Kenny Lear, or
yeah. And I remember being at his apartment, and he's got that balcony that looks outside the park, and it's an awesome place.
Yeah.
And I was spending all day on that thing, and he was just starting the idea of Huffington Post then, and you guys were in there, right?
Yeah, we were. What's interesting about the venture business too is like Greycroft is a play in 5 or 6 acts. And when we started, we were a digital media fund. So in 2006, I'm guessing 70% of our portfolio was ad supported. A lot of consumer media and media tools and software that's sold to publishers and media companies, and marketing automation stuff, which was, again, going through agencies and finding its way into ad-supported product. And in that first fund, the big hero outcomes were Buddy Media in New York, which was a great exit to Salesforce, Wide Orbit, which is a software product that sells to TV programmers, and a company called Extreme Reach that you probably haven't heard of. But it's up in Boston, and they're kind of the infrastructure software for the global video ad industry. So they do all they take the creative files from agencies, transcode them, and deliver them to everything from Facebook to NBC, and then they do the talent and rights management for that industry too. But it's a big company.
Did that change its name to Longtail?
That's a different company. That's JW Player.
Yeah, that's right. Somehow I made my way into that company. I don't even know how, but
it's a great business. It's a great business. And then I think over time, that portfolio and the firm has moved from being media and publishing and publisher tool centric to multidisciplinary. So we're doing a lot in fintech and global insurance contracts and healthcare IT and software. Our enterprise software practice is now roughly half of all of the firm's investments, and then broad consumer internet. And it's just part of scaling. We said we were going to invest in everything that touched the internet. And as our firm has gotten bigger, the opportunity set's gotten better. And we've also tried to identify spaces where we can invest and take companies public. I think part of the concern with companies like the Huffington Post, which was a great business, was that it was not going to be a great public company. And we knew that. We knew we'd sell it to a multi-brand media operator that had, consumer subscription through an MVNO and a bunch of other assets.
You mind if I interrupt? Because it's like a lunch, and if we were having lunch, I would interrupt because
Interrupt. Go ahead. Fire away.
I'm very inquisitive, though. So from the time that you invested to the time that you sold the Huffington Post was how long of a period? And you anticipated on your first round in your first investment into it that it would be acquired.
Yeah, we were certain that was going to be acquired. Our thesis really in the beginning was about building companies to exit them in a trade sale. We didn't anticipate having many, if any, IPOs with our digital media focus in the first fund. And with Huffington Post, I think we were in it for 3 or 4 years. And this is going to stretch my memory because we exited it over a decade ago, but it was roughly, I think we sold it for $360 million or something. And, our entry price was 16, 20. So it was a really good multiple.
I never really used to look at Huffington Post, and except my mentor who co-founded CNN with Ted Turner and then founded the Food Network used to, the place he used to vent about how bad CNN has deteriorated from the journalist perspective. What he did, and from the operational perspective was Huffington Post. So,
the Huffington Post, so Jonah Peretti was the genius of the Huffington Post. And what they figured out how to do, there's probably 2 pieces to the Huffington Post puzzle. One is they built this great flywheel, which was kind of the nature of all social media, but they weren't really a social media site, where the bigger you are, the more people want to write for you because they want a megaphone. So and then the more people who write for you, the more content you create. The more content you create, the better you index. The better you index, the bigger you get. So they were riding that early social cycle through Google SEO really well in 07, 08, 09.
And did you realize this at the time, or are now kind of a retrospective on how it worked out?
That was obvious. That part of their pitch. What makes entrepreneurs awesome. And this is the best part of my job. So they'll come in and they'll have an insight about the way the world works that is really out there. And then once they say it, you're like, oh yeah,
I know.
That makes a lot of sense. And in the case of Huffington Post, one was that cycle, which now other people, BuzzFeed does it too, because Jonah's second act. But it was always, content begets SEO, begets more traffic, begets more content. And the second thing that they did, which really supercharged this, and there's other companies that were doing similar things, but they figured out around the election cycle, I guess it was 12 years ago, so 2008, that people would search your name to see your election contributions. There's a big deal, like who donated to whom.
Yeah.
And so they created a billion landing pages. Like you'd search for Adam Townsend, and I think you'd get this page on the Huffington Post that had all of your political contributions.
I had no idea that they did.
Yeah. And nobody was actually SEOing individual name content. So they got millions and millions of uniques through this SEO hack. And they were able to keep that traffic because people who were passerbys became addicts. They said, oh, this Huffington Post thing is interesting. And next thing you know, their traffic would go up in a step function. And, that was part of Jonah's unique skill set, was figuring out these traffic holes in the internet where you could build stuff.
It's interesting, and there's a lot of questions here, and I'm about to put them up because I see Jimmy Uria here. So thank you so much for being here. I guess I became an investor in Slack, and we were discussing them over the weekend a little bit. because I think I was with Matt Straz, who created the company Namely, if you remember Namely.
Oh, very well.
Yeah, and they were one of the TriNet clones, right? I mean, a lot of people tried to be TriNet, a lot of people tried to be Insperity, and
They were trying it without the PPO.
yeah, without the PEO. And I saw a lot of inferior companies trying to do that. I saw Zenefits trying to do that. I advised the board of directors. I was part of that swap out from Fidelity to the Cross, and it doesn't make a difference. But I met with, I guess, Parker, was it? Parker? And I knew how to
Parker at Zenefits.
Yeah, and I knew how to do the post-mortem while the body was still warm. So I think David Sachs got into that, and I knew that it was not going to do good. But I know a lot of companies have tried to replicate. So I became an investor in Slack because I was no longer interested in TriNet or Workday, TriNet or Insperity in that PEO model, because you could no longer compete. They hit size. All you could do was be a little bit of interference on the very low-hanging fruit clients, which have usually aged out, and they're no longer that profitable anyway. They've negotiated their way over 8 years to no longer be profitable.
Yeah.
So I became an investor in them because Matt Straz over dinner said that Slack is the new thing. It's new within a company environment because they push notifications, and that was the first I ever heard of it. And another company that I was really intrigued by when you guys did it, because I didn't understand it, was the Trunk Club.
Yeah. Yeah.
I was a big consumer of theirs. They used to send me stuff all the time.
So I think this gets into Greycroft's second act. So when we were getting out of media, I mean, not out, but like exploring new areas to go into, one of the areas we had a thesis around was vertical commerce and online commerce in general. And we were hunting for areas where Amazon couldn't compete, or at least wasn't competing well. And at the time, now this is also 10 years ago, there was no fashion on Amazon. And even today, fashion retail has largely eluded Amazon's grasp. So we made some plays in fashion very intentionally, understanding that you could build a scaled company in that space. And look at Stitch Fix, which is the even better version. We were in Trunk Club, which they popularized the stylist on demand model. And their view was, if you get a guy like me or you, and you have a stylist that sits in between us, and you can basically reach back out to people and get them to order a couple times a year, and you can try stuff on at home, and the try-on experience is garbage. And as you know, men's department store is terrible. It's in the basement.
I refuse to go to them. I don't like men's clothing stores because I don't like being persuaded that I don't wear ties anymore, but that this suit looks better on me. I don't really care. I just want to get in and get out of there. And I really like the experience, although they didn't do suits. They did more casual wear.
Yeah, they do suits now.
Really?
Yeah, towards the end, they did men's dress clothes too, custom made to measure clothing. And I think part of the Nordstrom acquisition was scaling that part of their business too. Anyway, so long story short, we were in that business. We sold it. It was a great exit. The bigger outcome was in women's. And for various reasons, Brian and the team at Trunk Club didn't go into women's, and they probably should have. As you've seen with Stitch Fix, that the Stitch Fix twist on the model was charging separately for the stylist to get people into membership commerce, which retains even better than the services model at Trunk Club.
We have a lot of questions here, and I want to be responsive to them.
Keep going.
I will say that the reason I never got involved with a lot of younger funds at that time is because everybody was into mobile and consumer consumption. And I am not a consumer consumption person at all. I don't understand it. I have I guess a 6-year-old Pixel.
It's only 70% of the US economy. You should understand it.
Yeah, but I don't. I understand services business. I understand the encryption business. I understand the defense business. I understand things that go boom, right? But I just don't understand that. So I want to, and I've turned down a lot of funds that have worked out really well in that category. I've never even heard of Stitch Fix. Isn't that crazy?
You never heard of Stitch Fix?
No, I just.
It's a $3 billion market cap publicly traded company. You should check it out.
Yeah, I liked Rent the Runway though. I thought that was really good. And
I like
there's
Stitch Fix better.
really, really.
I don't really like the asset utilization business. So there's a lot of companies that they buy something and then you use it 50 times and throw it away, and they're just running that cost appreciation curve. They tend to be pretty capital intensive businesses, and fixed asset utilization is tricky unless you have the manufacturers essentially assuming all of your capital costs as you scale.
So we're gonna.
And you've got issues with used product that's end of life that you have to dispose of and all that.
Yeah.
Let's go to questions. What have you got from questions?
Well, first, I want to thank Lex UC for being here, because Fax Machine is kind of funny, right? That was 2006, and that was already kind of an old technology.
Yes, it was. But I think that will also give you some indication of the age of our average investor in 2006 too.
Yeah. So do you think that part of the reason that Alan brought you on, which because that's more than just kind of bringing on a partner, right? He's got a lot of knowledge.
I was 26,
but he's got a lot of knowledge, a lifetime of knowledge at that point, that he has to transfer over to you. So he's making a real commitment to you to spend the time transferring it over, and you made a real commitment to him to be kind of a good receptacle, for all of that.
Yeah, a vessel. The funny thing about this was that I had friends who thought I was crazy. Like, what,
Wow.
you're joining this guy Alan, who's 71, to go on a $30 million fund. Like, why would you do that? Why don't you just go to KKR or something? I never thought twice about it. I was like, this is going to be great. You can build something.
Yeah.
But you have to have a certain mentality about wanting to be a builder.
And do you think that part of his reasoning, and then I really want to get to the questions because they're so interesting.
Yeah.
But I've been very lucky that I've had great mentors, right? And without mentors, I don't think I would have done well. So from my experience, one of the reasons they've kind of adopted me and I've adopted them is because they're just not connected to what's new, right? I wouldn't say they're a relic, because that kind of sounds kind of nasty, but their own group of investors or lawyers or people are now old and retiring, and they're all kind of disinterested now, and they want to stay active, and they want to keep activated.
Well, yeah, and for Alan, it's hard to go inside his head, but I think that there was, and you could ask him now. I mean, he's still active at age 86, but I think part of this is relevance. And he was, when I met him in 2006, he was talking about podcasting.
Wow.
There aren't a lot, and this is before the iPhone. So I don't even know. It was podcasting to your iPod.
Wow.
And he was in love with this idea. Fast forward 15 years later, we're in Wondery and Podchaser and Podsites and a dozen podcasting companies. Alan has done all those deals. He loves the space.
Wow. I'm so happy.
It keeps you young, I think. That and working with all the entrepreneurs and bringing your ideas. So we got a question here. Should I answer this one? How hinged is your investment thesis tied to a dovish Fed?
Yeah.
Oh, wow. Not at all. How's that for a short answer? Let me give a longer answer. Venture is this really illiquid, decade-long holding period asset class. So if we're investing today, I don't know when the train is going to stop, but it's probably not stopping for 5 or 10 years from this specific company's perspective. So I'm investing in businesses that I think can compound revenue growth 100% or greater a year for a decade. And I'm looking across sectors, Michael, what's the secular trend that's driving the demand that will enable that to happen? Because the US economy is growing at 2%. So you're taking pretty significant share at some point from either an incumbent, or you're developing a brand new industry for the first time. But either way, you need pretty big growth avenues to do that. And my view is, if we're investing in a company at 10 or $20 million valuation and it's doing 2 million in revenue. If it doubles for 7 years, it's doing 100 times more revenue in 7 years than it's doing at the time we enter. So you have this business that then is doing 200 million of revenue, and I'm going to be way in the money. And the Fed activity and exit multiples and the public markets, that kind of ebbs and flows. And there are times when we're going to make a lot of money because multiples are really high. So you make it on growth and you make it on multiple appreciation. And there are times we're just going to make good money. We're in a lot of money environment right now because everything we invested in 10 years ago, we have not only growth, but we also have multiple appreciation, which really helps.
Yeah, and you and I were discussing this a little bit over the weekend because we have a slightly different stance on it, which makes it kind of interesting, right? Yeah. I see, I lived through, I guess I endured, right, the kind of conglomerates of the late 1980s and the early 1990s. And back then, they were all being, actually the mid 1980s to early 1990s. And back then, they were all being financed by junk. And that junk was 7-8%, 9, I remember 9%, I remember 10%. And I even remember 15% because Mike Milken was making Salomon Brothers was making a bunch of money at 15%, and they made a huge spread on them. Yeah, incredible business. And now I see that we're seeing that same type of conglomerate, but we're seeing a defragmentation of the world, right? We're seeing a cartelization of the world. And now my perspective, and I could be wrong, but these are my bets, is that it's all being kind of financed by the Fed. The cost of the money is so cheap that they're incentivized.
Yeah, I think you and I are on different sides here because the companies that you think are the new cartels don't use debt. So cost of capital is irrelevant, right, from the government perspective for Google and Facebook and Microsoft and Apple. They don't give a shit. That could be 100%. I mean, it's irrelevant. They've got cash flow. The companies that are reliant on the Fed to keep interest rates low are not growing at the pace of the companies we're funding or the companies that you're interested in.
Yeah, I look at it a little bit differently, but I also include within that it's not the new companies that are building the cartels. It's kind of the legacy companies that already had a monopoly that are now just really building I would hate to say moats, but they're constructing very onerous regulation that really doesn't permit any new entrant. So they can win against Lemonade and everybody else just by attrition. Omar, thank you so much for being here. And Omar asked, what are your thoughts on life science investments into 2021 post-COVID?
It's not a space as a firm that we've spent a lot of time on, so I'll give that caveat. But I'm really intellectually interested in technology like CRISPR and all the biohacking that's going on. Based upon what we've seen also in advances in machine learning and modeling, because it's really expensive, as you know, to run clinical trials and to identify compounds. And I think that a lot of computer simulation work is going to dramatically reduce the price of that in the future. So I'm really bullish on life sciences and drug development as a category, because I think there's going to be a lot of breakthroughs over the next 10 or 20 years that will create a lot of value. I think that there's a fraught regulatory environment, like who's going to pay and how much are they going to pay. And if you had a pill today that added 5 years to your life by reducing the rate at which your telomeres shorten, like what is the value of that? How do you price life? Like, we get into all of these strange questions, and I'm a little worried that these things are perceived as public goods, which would make it much harder for the companies that make them to generate profits and even return the capital they have to expend to develop them in the first place. But broadly speaking, I think it's a really interesting area in science. And I think there's a lot of technical advancements that are pent up and coming. And you've seen that also in IPOs and such.
Very interesting. Very interesting. And Valina, thank you so much for being here. And Valina actually joined me on the first investor series, which was like a debut. We didn't really know what to expect, except we wanted to have fun. And our operating thesis that we both share is that the world is being bifurcated, and that the U.S. and China kind of won the world. And now everybody's having to choose their allies, very rigidly choose their allies, while as before it could be ad hoc, right? They could take a little piece from a whole bunch of things. And U.S. and China, because innovation is so expensive, are looking downstream. They're both competing for Africa. They're both competing in their own way for India, for what's going to be the nucleus of innovation and who's got the most developed side, who's got the most developed supply chains, the densest supply chains. It's very interesting. So Valina asks, and thank you again, says, hello, Adam and Ian. Great talk. Could you name 3 sectors that would be great for startups in 2021?
Yeah. So I'll tell you how we've organized the firm and it will give you some color. So one of the 3 for us is fintech and insurance. And, that's a huge overarching space. So we break that up further into consumer and enterprise. And then even in enterprise, we've got 5 or 6 different software-based theses areas. And then in consumer, we have a number 2. But so I think there's going to be continued innovation in the fintech and insurance space. In spite, Adam, of what you may think about cartels and existing businesses trying to set up moats, there's so much happening that I think it will be very hard for the big legacy banks to keep the genie in the bottle.
With banks, I certainly agree. Banks, I definitely agree. But I'm not a specialist in those things. I really, you've become a specialist in so many things, and it's just so remarkable hearing you discuss them. I stick to so few things, and I just know them really, really well. And we also discussed them a little bit over the weekend. My thesis for investing for the last several years has been there's going to be wars. And one of the things that I've been a very active investor is encryption. Encryption is taking over the world. And when you have Space Force, which we will have, encryption becomes vital. It's the way we're going to keep our satellites up there and the way we're going to keep our people safe.
Yeah. So I'd say, well, the second, I'll give the other 2 spaces really quickly, just so we can go through.
No,
the second space, I'd say, we're looking at enterprise software and specifically what we call intelligent applications. So there's this broader movement from on-prem to SaaS, and then SaaS to what? And more and more frequently, SaaS applications are being built with, I guess a framework where every incremental customer adds data to the app, which in turn you can write ML on top of and make the app smarter. And we're just seeing really interesting advancements there. And I bet that the Workdays and Salesforces and other established SaaS leaders are going to lose some share over the next 10 years to new entrants that are built on better ML frameworks and can therefore automate more business tasks. And then I think the third space, we're doing a lot at the moment in digital healthcare. One fascinating statistic. So before COVID, guess this, Adam, what percent of the US population pre-COVID had a telehealth visit?
I hate speculating, but I'm going to say 4%.
0.1.
Really?
0.1. We get what percent today, 10 months, 11 months later, has now had a telehealth visit?
Can I just say larger than that?
70.
Really?
70.
Wow.
Yeah. So do the math on that growth. And what does that mean? And we spent a lot of time thinking about this. I mean, it's.
Can I interrupt for just 1 second? Because it's so interesting. What about those people who are still very bandwidth constrained, whose entire internet experience is really kind of a small screen and kind of low bandwidth type of environment?
Telehealth. It's on their phone. It's remarkable. And broadband penetration through 4G, 5G is pretty high in the US. So yeah, it's unbelievable.
Is there a consumer profile that you've been able, kind of like a psychographic demographics type of thing, in terms of age groups of the people who are kind of participants in that?
It's everybody.
And is there kind of a wealth bracket as well at this point? Are we seeing?
I mean, we're talking everybody.
Wow.
That's the U.S. population. I mean, it's a big number. This is everybody.
And what companies do you have in that category?
Eden Health, Octave for mental health, Brave Care for pediatric. I'm forgetting. So we have substance abuse. You know, the federal government, you couldn't pre-COVID prescribe the drugs that are used for opioid addiction. They are themselves a controlled class of substances. Now you can prescribe them through a doctor's telehealth visit. So, you know, we're seeing a sea change in the way that the entire healthcare space is navigating this. And telehealth's really effective. You know, I think over half of primary care visits can be avoided altogether through telehealth. So you just think about what that means. Like, your doctor can be anywhere in the world. You can get concierge quality medicine from the push of a button.
It's incredible. I remember companies that were kind of, I suppose at that time, innovative in a space, which was like Sherpa, if you remember those guys.
Oh, yeah.
And is this just kind of...
I think the issue with like a Sherpa and the Gen 1 companies, which you can correct me if I'm wrong, but I think they involve bringing a doctor to you. And a lot of people were, you know, like, we'll bring a doctor to come to your house and do a house call. And the problem is the doctors are your really valuable resource. So you don't, and the traffic and scheduling is hard. So you want to utilize them and keep them in a central place where everything is done. You just minimize travel time. So, you know, telehealth is a perfect solution because you don't have to travel at all. Nobody travels.
Remarkable. So I'm going to skip around. I put it on the screen before, and I've never heard of a lot. I'm just not a good consumer. I try and live a very kind of simple life. I've got a very old Pixel 2. Like the celebrity in the house because she's got I guess a Samsung 10.
Well, get yourself an iPhone.
What is that?
Get yourself an iPhone.
iPhone can't work in the secure environments that I need. So it's a real problem.
We'll talk about that later.
Yeah, they can't, and they can't, and there's certain issues, and I've got to comply with. So I've got a modded kind of a BlackBerry type of formation, and then I've got an app that I use called Silent Circle, which is a little bit different, which is built onto an Android platform, and it's stuff that you would actually be really interested in. Because I've got to deal with a lot of national security type of companies, but I will say I never heard of Stitch Fix, so I'm delighted to hear that.
Company. All right.
So Asaya, thank you so much for joining us. Blessed day, and thank you, and thank you. My thoughts are with you also. Thank you both for being here. What do you believe about EdTech, Miami tech ecosystem?
So, you know, we've dabbled in EdTech. We're not as bullish on EdTech as we are on other sectors. And part of the issue is figuring out who pays for it and how, and figuring out the addressable markets, because it's fragmented between K through 12 and post-secondary and coding camps and everything else. I think as a consumer, and I've got a 3 and a 6-year-old, I've got 2 little kids. So I see how broken the current digital learning environment and experiences in public schools. I just don't know how to solve it the same way that Facebook solved like the social media issue and built a winner take all business, because, you know, people don't really pay directly. They pay through their property taxes for education. So it's not like I can take my personal budget and reallocate it. The government does that for me. And I will likely continue to pay those taxes regardless of what new ed tech companies come along because there's teachers unions and there's a lot of infrastructure built. So it's not as easy to come up with better, faster, cheaper, and just take big share like it is in other spaces. But there will be companies built, and I think there's a lot happening in post-secondary where it's a little bit more of a consumer discretionary purchase. Like, do I go to college or do I do something else? And that's an interesting space, as well as test training, test prep. All of those purchases that are consumer discretionary are easier to enter because you have wallet. And you can scale fast. In the Miami tech ecosystem, boy, I don't know. I'm one of the people watching, people move to Miami and people move to Texas, and I think to myself, good luck.
Well, it's a friendlier taxing regime, and it's a friendly, and it's we have such a hostile regime now in New York, and Bill's been a friend of mine for 20 years, but it is what it is, and when you impose a lot of regulations, it also introduces a lot of new costs and a lot of the unknown unknowns, which are really dangerous. So
I'd say there's two pieces. If New York City was a place that people really wanted to live, which at the moment it's not because of COVID, so assume for a minute that it is in the future, taxes are a secondary consideration because it's not that different. If you're an entrepreneur who doesn't make a lot of money and you're building a company, you go where the talent is and you go where you really want to live. I think Miami at the moment has better weather, particularly as we're here in a New York winter, but arts and culture and restaurant life and everything else has historically been, in sports, a distant second to New York. And the talent pool in New York has been 10x deeper, maybe 50x deeper in tech, where you've got Facebook and Google, and everybody has deep tech bench. So I think it's hard because we're not in a capital constrained environment. We're in a talent constrained environment, and you'd have to see a lot of people move to these cities to create ecosystems. And it may happen, but it could take well over a decade.
And thank you so much. And Kim, thank you so much for being here. And I'm going to answer this in part, if that would be all right.
Go for it.
As a VC, and Kim asked, as a VC, what do you think differentiated you over the last 10 years? So let me respond to the first half of that, because clearly I'm not a venture capitalist. I'm on the other side of the of that desk, right? So I'm on the investor side, and I'll tell you what has. And I'm not an investor in Greycroft, so I want people to know that.
You should be, though. We could talk about that later.
Yeah, well, you discussed SPACs with me, which is something I'm interested in. Yeah. But again, that's for a different time. And I had Anthony Pompliano on, and he was telling me that I should invest in Bitcoin. And he was right, because Bitcoin has emerged out of the laboratory and it's doubled in the last 4 months. So I accept those things. I accept the domain of my own ignorance, right? But so it's interesting, because from my perspective, having been through the 90s, the 2000s, we had, and then working on the corporate side, which is where we had Insperity, it used to be called Administaf, go from $40 to $2 a share, and then kind of come back from 2 to about 130 now, I guess. I've always evaluated investment managers not as much by their mark-to-market performance, because there's you have to kind of forecast kind of the market appetites in a year or 2 or 5 years. So those are unknown type of things. You've got to be willing to have companies sit on the bench waiting for a liquidity event, or things going wrong, or entrepreneurs, not being good entrepreneurs. So how I've evaluated is kind of an emotional one, right? I wonder to myself, what will happen in a down market? What will happen in a down market? And because most of the venture capitalists are young, and they've never had to tolerate and emotionally endure a down market. They've never seen one. And in March of 2000 of this year, the market's plummeted, right? And
Mm-hmm.
I went on Twitter, and everybody knows, I'm a shareholder in Boeing and a whole bunch of other companies, Tesla, Lockheed, and a whole bunch of other companies, Facebook. And I was like, people have to buy this. And I saw a lot of venture capitalists kind of bemoaning their own imaginative fates. And I could see right then that there was a real kind of chasm between those who have the reservoir of the emotional reservoir to endure a bad market, and those who don't. And so one of the qualifications that I would think with you, right? And although I'm not an investor, but it is what it is, right?
Yeah.
Is you have Alan, just as I had kind of my person who said, you got to answer the phone. You know what I mean? It's really good when you have somebody there who's been through it, who says, you've got to answer the phone. You can't hide under your desk. And it's really a qualitative difference. It really is. So with that, my answer is complete. Could you do that?
I'll add a little bit of inside baseball. Venture is a hand-to-hand combat business, and I could wake up and on a plane ride someplace sit next to the next Mark Zuckerberg. By the time the plane lands, have a handshake agreement, wire money over, and be the most successful venture capitalist in America on pure circumstance. And I think that what has worked for us at Greycroft really well over the last 10 years is we've got, founder partners who are kind of, just I'll give you kind of the high level background, Adam. Like if we compete against Sequoia, for instance, in a deal, unlike Sequoia, which has been around for decades, the founders of Greycroft are active and at a stage in their career where they're growing fast. And I think founders like to work with founders, and they see some kindred spirit there. Whereas the folks who work for our competitors are pretty much employees.
Yeah, it's interesting.
They started companies in the past, but now they're employees. And I think that's a big lift. When I sit down with somebody, I say, here's where we're going with Greycroft, and I'm going to be here for a long time. They're like, that sounds great, and we want somebody who can help scale our business from seed through IPO, and we know that's going to be a decade. And you're building your platform, and I think we're good at the hand-to-hand combat piece of the business.
Yeah, you guys have been remarkable, and I've watched from a distance, but a close distance. So, Clay Space, thank you so much for being here. You mentioned getting into venture capital means having a builder mindset. What's being a builder mean to you?
Taking risk, first off. Second off, I think the strategy about where to go and what to do next. And third is you have to be really curious. Like when we screen folks and talk to them about roles at the firm, like, what do you read? What do you do? What are you interested in? And the people who are the best are kind of info junkies, where they'll read science fiction, and then they'll read Blink, and then they start making connections between stuff that it's a little bit out there. Like, well, that actually is pretty interesting. I never thought about how these three things connect before. It helps to have a really broad interest in how a lot of things work, because learnings from one conversation and company can be equally applied across industry. And entrepreneurs want somebody in their corner who can help them with the strategy and the ideas, and have seen a lot of things.
So I remember back having our breakfast in the Regency, right? In the old library room, right? At that time, I was getting involved in defense. And I spent a lot of time in DC kind of wooing a lot of the generals who were retiring out and didn't know how to prioritize their time. They had a great idea. They didn't know how to scale a company, because whenever they needed to build a company internally within the NSA or whatever their environment was, they could just call up the HR department and have and have resources reallocated to them.
Yeah.
And so, it's interesting, but those entrepreneurs are horrible at their time allocation. And I found that many times they're great entrepreneurs in many ways, even cryptologists, which I deal a lot with, but they're really bad at building companies because they don't have that kind of connectivity, that communication skill set. So are you pairing a lot of the entrepreneurs you meet who you find some type of gaps? Are you pairing them?
I think one of the criteria we have when we meet an entrepreneur is like, would we work for this person? Because somebody who is a genius but can't communicate, can't hire, and can't sell is not likely to be successful. Occasionally you get the genius that you can pair, Sheryl Sandberg to. And that's not normal. Most of the time, the founder has to take the company herself all the way, and we're trying to find people who can do that, it's a big bar. And there's a lot of examples of Sergey and Larry needing Eric Schmidt and Zuck needing Sheryl Sandberg to help them scale their companies because they were younger and inexperienced managers at the time. And it's good to have a strong number two. But as you've seen, Larry and Sergey have been really capable as managers, over the course of their career. And I think Zuckerberg's capable as a manager over the course of his career. People who don't have that capability because it's just not in their personality or they're not born with those traits are really hard to coach into world-class CEOs.
Have you had to replace CEOs frequently or management teams? Is that part of your expectation when you make an investment?
No, we want to invest in a company if we think we have to replace the CEO.
And we're going to continue to go on. So hold on, let me click that button. And we've got a bunch, so I'm going to rip through them now. Now, right, we enter, and there's so many good questions, so I want you to be responsive to them. It's like a speed round. You know what I mean? Like, isn't that exciting, right? So Compound 248, thank you so much for being here. Asks, how do you see the next 5 years playing out in payments, Visa versus banks versus PYPL, SQ versus pure APIs?
World moves towards more API-driven software. Mobile is a big point of differentiation. Banks have terrible mobile development teams. So I think PayPal, Square, and others take big share.
That was good. That was quick. The Emissary Code, thank you so much for being here, says, what industry, and you can go a little bit longer, right?
Okay, well, you said rapid fire. I don't know.
I'll ring the bell.
Question you got?
It's going to get rapider, but right now we're just at
okay.
Okay. So
by the way, I had one funny story for 1 minute, not on this last time, but the topic before. When I was in business school, the founder of Sequoia, Don Valentine, came and gave this big talk. We filled up the whole auditorium, like 600 kids. And he said, for 600 business school students, at Sequoia, we don't invest in entrepreneurs, we replace them. This is the founder of Sequoia. And this is recent, like relatively recent history. And I realized at that moment just how weak a lot of the first generation folks were, because if that was truly their mindset, that was a huge opportunity for new firms to emerge that could cultivate kind of the voice of the entrepreneur. Anyway, go ahead. Next.
Emissary Company, again, thank you so much for being here. Says, what industry sector excites you but is too apprehensive for you to personally, for you to invest?
I would say clean tech.
Oh, really?
I think it's really capital intensive, which is my concern. But there's huge macro trends that are moving in that direction, including like energy production, space. It's the other category. I got really interesting what's going on. Asteroid mining companies. And, but our funds are too small.
Yeah, they are. And one of the difficulties is that space goes from seed round, because I'm involved with it in India. It goes from C round to a D round. And
I know. You're like $100 million to get product.
Yeah, and you've got to accept as an investor that you're getting a really good deal on the way in, right? Because you're helping them scale and you bring some type of basis point type of improvement to their operational
Yeah.
level. But you have to also accept that you don't belong in the D round. You just don't belong because it is what it is.
And if you can't stay at the table, it's really hard to start. And if you know in advance that you can't stay at the table, you got a lot of downstream follow-on funding risk. And I'm just not comfortable enough to take a trust fall into the forward markets that somebody else is going to be there to support the company.
Yeah.
Anyway.
Okay, so we're going on. And iConstable, thank you so much for being here. Ask Ian, what do you think about distributing to LPs versus holding long-term post-IPO?
This is an amazing question. And we've spent a lot of time thinking about this, and our point of view is changing on it. So you have to understand, like, there's two minds here. The LPs kind of want the shares when lockup expires. Most of them do, at least. And increasingly, we're seeing venture funds hold longer. And if you think about it from the VC's perspective, and really from the LP's perspective, they don't pay me any more to hold on versus sell, because, let's say that you're in carry on the fund, they're getting 80% of the shares and you're keeping 20% of the shares, and there's no incremental management fee for holding this public position. So regardless of whether the stock doubles, triples, quadruples, they're still getting the same 80% of the shares either way. And in some ways, we're helping them with the decision, because if we distribute the stock, they likely have to sell it. Depends on the fund and the characteristics. So increasingly, we're becoming longer term holders in some of these companies, because we have a view that the stock will continue to go up over the next 4 or 5 years. But it's currently case by case.
Cami Rosa, thank you so much for being here. And she is a fellow Ultra Ironman. I'm not sure if you just Ironman or Ultra Ironman. So I'm not sure if you crossed that type of hurdle, right? But thank you so much for being here. What is your view on market opportunity in neurotech, such as Kernel's neuroscience as a service?
Oh, I think it's interesting, but I think there's a lot of technical risk, which, you've got kind of, and it can't be mitigated, which is the challenge in certain sectors.
And Tim Heidegger, thank you so much for being here. Ask, from a cyber perspective, what are the next and new subsector types? Example, defense, identity.
Physical security, a lot going on in camera and office security, how you're going to move from key card based access solutions to biometric solutions for physical and proximity. There's a lot going on in social, managing bots and fake accounts and people who set up dummy pages that they try to impersonate you to get information. There's a lot going on also in device. So, like the microphone I'm using right now could be hacked. I wouldn't know it ever. And it could be listening in the background and doing all sorts of stuff. And as IoT gets more and more spread, I think there's just a lot of interesting avenues for people to build big software companies.
And is that part of your fund right now, or is that
we have about a dozen. Data security, how companies, because increasingly what you're seeing is companies will have data scientists that need to access 5 or 6 different pools of data in order to do their job. And if you commingle it, you can figure out where somebody lives. So you've got to obfuscate enough that the data scientist can't get PII, but give them enough ability to actually do their job. And there's a lot of really smart tech coming there too. But yeah, we've got a lot of investments, Muta and God, what's the other one in New York? Red. God, we've got like just 12 of them. It's not my roadmap, but yeah, we've got a lot there.
And Dagny Dream, thank you so much for being here. And she says, working in gene therapy, it is advancing fast in disease therapy, cancer, but takes forever for FDA approval.
That's a fact. I can't control the FDA, unfortunately.
Yeah,
And I don't know that. I mean, look at the vaccine timeline. It's just hard.
it is. It is. And we're going to see.
If you think about the fact that the vaccine was available in February, it's the same vaccine that's coming now. There have been no changes to it.
Yeah.
And so the US will lose 500,000 lives unnecessarily because of process. And I don't know that there's a right solution. I also don't know that the vaccine is any safer today than it was in February. It's not like they've had 10 years to look at long stream downturn adverse effects yet. So it's just.
Yeah. I'm gonna keep away from that though, because
yeah, well, and we're out of time anyway, but go ahead.
we're almost out of time. Now we're in a real speed round, so now we made it. When it comes to quantum computing R&D, where do you see the encryption industry in 3 to 5 years?
Different. I don't. The short answer is I don't know, but I do think quantum computing won't be here in 3 years, so it's probably more like 5 to 10.
And Tracy, who goes by Chigirl, thank you so much for being here. And she is truly a specialist in fossil fuels. So how do you see AI tech, given that companies like Palantir are heavily invested AI and energy industry?
Well, Palantir does one thing really well, which is anomaly detection. There's a lot coming in reinforcement learning and other models that are different. And so I think Palantir will own their swim lane, but there's probably 20 other swim lanes. And that means there's likely to be 20 other companies with the scale and revenue of a Palantir in the future.
And Chandra, is that your assistant, Chandra?
I've heard of Chandra.
It is. And what a wonderful conversation we had. A long, wonderful conversation. Says Eden Health is an amazing company. Could you help me actually better understand what Eden Health, I understand their telemedicine, but what is it differentiates them from all the other entrants into that market?
So you'll get this from your TriNet background, but they're B2B2C. So they'll go to a corporate and say, look, there's a lightweight concierge approach similar to like the One Medical product, but instead of your employees paying by themselves, we do it as a corporate benefit, and we'll enroll your whole office, and we'll do on-site vaccinations, plus you'll get access to 24/7 telehealth, plus our clinics, plus. And it's been scaling really fast because, as you know, employers pay for 60% of all health insurance expense in the United States.
And we're going to go to Lex Yusi, so thank you again. And I guess this is a good opportunity to also discuss Alan Patricof with what he did with, the Cornell Technion, if I recall. So Lex Yusi asked, how does tech change a talent-constrained environment to attract tech talent?
I think the egg is, entrepreneurs attract talent too, right? So they'll come in and terraform. If Bill Gates didn't want to build Microsoft in Seattle and Jeff Bezos didn't want to build Amazon in Seattle, Seattle would be very different. Just in an alternate universe, there'd be no tech there. Those two entrepreneurs, through force of will, built an entire tech ecosystem in a city. So you can do it. It's just the probability of success is higher in markets that already have a deep bench of talent. And then the second thing that ends up happening is that companies will sell on the way up. So if Microsoft had sold along the way to IBM for $1 billion, the future of the entire Seattle ecosystem would have been different. And that's what happened to Boston in the first internet bubble. Is the best companies in Boston were bought by the best companies in the Valley, and a lot of that talent went west.
I'm going to ring that bell, right? Because
we're done.
And now we're going to plow through everything. So Sonali, thank you so much for being here. And if I recall, you're in Malaysia, so it's early morning. Sonali asked, I have seen many, and this is a two-part question, so I'm going to click onto the other part also. Sonali says, I have seen many U.S. startups started well off, scaled, then closed in renewable energy. Why? Any info? And then she continues, how you see renewable energy startups doing in 2021.
It's not my space, so I don't really know. Can I take a pass?
Please do. Please do. And Janan, thank you so much for being here. Says, we have a specialization economy. Do you consider innovation through acquisitions a good value?
Yes.
Is that something you're encouraging your portfolio companies to do? Because there is kind of a cheaper cost for acquisition.
Particularly as you get bigger and you have an enterprise software and you have a sales team, you can start platforming, buy 3 or 4 ancillary products, roll them out against your current customers. Inorganic growth works.
And we at TriNet, we acquired our way to size.
Mm-hmm.
And then we created lots of verticals around them into different markets. So Tracy says, clean tech, good answer. So
there you go.
She's an expert. So if she says that, I would bring it to the bank. Janan, again, because now I'm scrolling down because we're kind of going to come to a close.
So we're really active in Africa. We're in Flutterwave, which is the big payment processor. I think China's kind of emerged. We're not in India at the moment. There's a lot of local VC there. And then Latin America, we've dabbled. It's trickier for us. So I guess that there's some TBD aspect to it, but I do think Africa will be an interesting area to invest over the next 10 or 15 years.
So in India, it's my experience that you guys really should be in India because the ecosystem is not.
Because you live there, but I have to go there, and you have to have people on the ground to really do it.
Yeah, well, the ecosystem there is not what you're used to. It's for them, the university system will see a company and they'll say, okay, come back in 10 years. And the venture capital system doesn't know how to price things. They don't know how to kind of market and develop, how to build the talent. It's just a different environment, particularly within the defense industry, within indigenous Make in India. And there's really.
I don't know that we know how to price things in the U.S. any better.
But you guys have more. It's more regimented here,
yes,
than it is there. So Tracy Liu, thank you so much for being here. Who writes The Future of You? Actually, I just ordered that book. What's going to be the gateway product to augmented humans? For example, eyewear, chip, or something else.
I think it's this. I think we're already augmented. Like if I got to use my eyes and look at how many go down the street in New York, everybody's on their phone all the time. So you don't need it. You don't need to wear your computer or have it plugged into your brain. You can have it in your hand.
And we're going to continue.
It's a cheat answer, but it's the truth.
And we're going to come to a close. I'm going to just search through the last few questions because there's so many. And we're going to go to Cami once again. So thank you again.
We're in Seed, which is a great company in microbiome. I think it's an interesting space. Waiting clinical data back on this sector, but probiotics and gut health is really important. But I think it's products first and apps second.
And we've now gone 1:08, and I want to be respectful of everybody's time, and I want to be respectful for your time. And I'm just so appreciative that everybody allowed us to be on their Twitter and Periscope feed. In closing, I will say I know Periscope is closing up its app. I've been familiar with that since August, and I've been actually kind of intimately involved with it for a whole bunch of different reasons. I'm actually excited about what comes next. I think it's going to be less bandwidth constrained. I think it's going to be able to just do a couple of things more. And so we're going to close up with no, we're not going to close up with that one, although thank you.
I like that question.
Okay, so then we will. I saw Chandra there, and I was going to close up with her question because it's Chandra.
Go ahead. What's her next? I haven't seen her question. What's her question?
It was a comment, actually.
Oh, okay, a comment's fine.
Okay, and I'll find out as you answer this. So Valina says, will we witness a shift of American capital away from China or stronger entanglement under Biden? And I don't mean the political implications. So I want to keep the politics out of it and just look at policy. Would that be all right?
I think stronger entanglement. From a capital perspective, the capital markets are too inextricably linked. And I think investment opportunities are going to be increasingly global. and Chinese nationals and Chinese corporates are going to be investing in the U.S. We're going to want them investing in the U.S. and we're going to want to invest over there because money's portable.
I'm looking for Chandra's comment about Stitch Fix. Was that the name of it?
Yeah.
So because I can't find it, hopefully, Chandra, you can write it again and then I'll include it. So it'll be our closing comment because then it'll show up on the screen. And in the meantime, as she types that out, furiously types that out, Vijay Kumar says, health tech, good investment for the next 10 years. And what is the impact from Amazon?
We'll see if Amazon's successful of getting into services because healthcare is still a services business. They're getting into obviously prescription and pharma. Amazon's entry doesn't scare me away. I just like it didn't scare away people in Stitch Fix and other e-commerce categories. This is one that it's not going to go all to Amazon overnight.
Do you think that Amazon creates a liquidity event, or do you see some type of?
I do think Amazon will buy other companies, assuming they're not subject to Justice Department antitrust issues.
Are you building companies just as you thought Huffington Post?
I don't build companies to sell to Amazon. I build companies to compete with Amazon.
Yeah. And so I want to see, and because she hasn't been able to type it in time, we're going to close with this comment. So thank you again, Vijay Kumar, for bringing it up there. And we're gonna close up. So I really appreciate everybody's. I was wondering if she typed it again, so she did. And I'm gonna look up Stitch Fix after this. I just don't know what's happening in the world today, I guess, and that type of stuff. So hopefully Ian and I were good guests, and I want to thank you, everybody, for allowing us onto your feed, and particularly thank you, Ian.
Thank you, Adam. Take care.
And I'm going to press on the upper right hand. You can't see it on your side, but I'm going to press that end broadcast button. And when we do, we're going to say goodbye to everybody. It'll be like closing credits. And Ian, if you would just stay with me for 1 second, would that be all right?
I'm staying.
Thank you, everybody. Bye.